Well, thank you very much for the invitation. It's a great pleasure to be here today virtually. Uh, as you noted, today I'll discuss economic developments in Vietnam. And before I go into more of the recent developments, let me say a few words about what happened in the last few decades in Vietnam. Vietnam's track record has been very impressive. Since the dawn of the free market Doi Moi reforms in 1986, rapid growth, almost 7% in the last decade, has lifted Vietnam from one of the poorest countries in the world to a lower middle income country. The key ingredients to achieve this were structural transformation from agriculture to a modern economy based on manufacturing and FDI-led growth, aided by trade liberalization since Vietnam joined the WTO in 2007, and in parallel, a declining contribution of the state and SOEs in particular in real GDP, as shown on the right-hand side chart. But also, there was a commitment to macroeconomic stability in recent years and an emphasis on leaving no one behind through inclusive growth policies that have boosted living standards across the board. And that's what you see on the left-hand chart. Now, my presentation today will focus on four key questions. The first is, what was the state of the economy before COVID? The second question is, how has Vietnam navigated through the crisis? The third is, what are the key risks and vulnerabilities? And the fourth, finally, will be, what are the medium-term opportunities and challenges? Vietnam had fiscal space prior to the pandemic. As shown on the left-hand chart, sustained fiscal consolidation and strong GDP growth reduced the public debt to GDP ratio to about 43% by the end of 2019. And this is our estimate based on the revised GDP. The quality and the composition of fiscal consolidation, however, has been suboptimal in some ways, with both capital expenditures and revenues either falling or stagnating as a share of GDP. Specifically on the revenue side, as shown on the right-hand side graph, the revenue to GDP ratio is lower than in peers, and this is in part due to generous tax incentives to attract FDI, including in special economic zones. Going forward, higher revenue mobilization will be crucial to close infrastructure gaps and address population aging and climate change over the long term. Accommodative monetary policy in the past has led to high credit growth, exchange rate pressures, and inflation, as you can see a little bit on the left-hand chart. But successful monetary stabilization since the great financial crisis has involved sharply bringing down credit growth while maintaining the exchange rate broadly stable and low inflation. Headline inflation has remained mostly close to the central bank's annual target since 2012. But the monetary policy framework remains complicated with multiple objectives and use of non-market-based instruments. So the exchange rate appears to be used as a nominal anchor, along with administered credit ceilings. Monetary policy transmission through interest rates appears to be weak, for instance, and that is shown on the right-hand side graph. The interbank rates are well below policy rates. On the external side, Strong exports, but also tourism and remittance inflows have supported growth and have translated into a rising current account surplus in recent years. The central bank has took advantage of strong inflows and benign external financing conditions prior to the pandemic to accumulate reserves, which, while keeping the exchange rate stable, so that now international reserves are at a record high. Vietnam's external position is substantially stronger than warranted by fundamentals and policies based on the 2019 IMF Article 4 consultation. However, a large part of the misalignment can be attributed to structural imbalances, such as underinvestment by the domestic private sector due to structural constraints and under execution of public infrastructure investment. Now let's turn quickly to how what has been Vietnam's experience with the COVID-19 crisis. Well, it would be fair to say that Vietnam's containment of the virus is a real success story so far, despite the recent outbreak in Da Nang. On the left-hand chart, as of yesterday, there's been about 1,000 confirmed cases and 25 deaths in a country of 100 million people. And prior to the recent outbreak, which was preceded by almost 100 days without local transmission, Vietnam had only 355 cases and no death. As shown in the middle chart, the early success was a result of rapid early action, including on contact tracing, testing, and quarantines, learning from Vietnam's past experience with SARS and MERS. Transparent and consistent communication and a clear public health response strategy were also key. The response was earlier and more aggressive than in other ASEAN countries, and this also allowed for an earlier easing of the lockdown and a reopening of the economy. This successful containment strategy is even more impressive given the status of Vietnam's health infrastructure, which is only slightly above the world average, as you can see on the right-hand chart. So the policy response has been targeted and cost-effective. So in addition to the successful containment strategy, growth has been supported by a swift and broad policy response. The government used the fiscal, monetary, and financial levers that is at its disposal to alleviate liquidity pressures on firms, save jobs, and support vulnerable households. The left-hand chart shows how Vietnam's quick response has allowed easing the fiscal burden compared to other countries. The right-hand chart shows a breakdown of the overall fiscal stimulus at around 3.6% of GDP. It includes tax and social insurance contribution deferrals, as well as support for SMEs and electricity price cuts. Existing cash transfer programs have been temporarily expended to cover part-time and those workers who lack unemployment insurance, the self-employed, the poor, and the near poor households. So far, the authorities have deployed limited below-the-line and quasi-fiscal measures, which is prudent in order to avoid the building up of contingent liabilities. Banks have also been accommodative with an estimated stock of measures of about 3.8% of GDP, which include restructuring and exempting interest payments for affected and new loans to assist borrowers. And monetary policy has been eased as well. Now we have various high-frequency indicators. PMI, retail sales, suggest that the domestic demand is at an early stage of recovery. Trade remains somewhat weaker, reflecting weak external demand, although there's been some improvement more recently. So thanks to earlier containment of the pandemic, the decline in GDP is expected to be much more moderated than other countries in the region, as you can see on the right-hand side chart. And growth is estimated at 2.7% in 2020. So what are the key risks and vulnerabilities arising from the crisis? One key risk is that the crisis will lead to adverse labor market consequences. The latest labor market survey indicates that 30.8 million workers have been affected, so that's about 2/3 of the labor force, either through wage cuts, layoffs, or reduced hours. The unemployment has increased slightly from 2.2% to 2.7% in Q2, and underemployment has tripled to 3%. The labor force fell by 4.3% year over year, with the female and rural workforce suffering the largest declines. Now, our research suggests that the most affected sectors, such as manufacturing, tourism, and hospitality, not only constitute a large share of overall employment, but also tend to have a high share of informal workers, as can be seen on the right-hand side chart. Informality is a major structural bottleneck, which is likely to exacerbate the negative impact of COVID-19. Another source of vulnerability is the corporate sector and rising financial sector fragilities. Vietnam's corporate sector, as in many other countries, is dominated by SMEs, many of which are in the hardest hit sectors, which entered the crisis in Vietnam with a relatively weak liquidity position. COVID-19 could have a substantial impact on profitability of these firms and increased debt at risk. Our analysis showed that liquidity support provided by the government has and will help temporarily alleviate corporate liquidity stress, but risks, of course, remain. The banking sector has been strengthened in recent years with rising profitability and improving asset quality, but fragilities remain before the COVID-19 shock. And as you can see from the right-hand side chart, the level of capital is low compared to regional peers. So what are the policy priorities in the short term? Well, measures to date to support the economy during the first phase of the crisis are appropriate, but Vietnam's domestic economy is already reopening, and policies must therefore be geared toward supporting and accelerating the recovery and safeguarding macroeconomic and financial stability. Specifically, specific priorities are threefold. The first is to rebalance fiscal support and to make it more targeted, and renewed emphasis on public investment and stimulate aggregate demand. The second priority is to maintain a supportive monetary policy stance as long as needed, and to allow for greater exchange rate flexibility to act as a shock absorber. And then the third priority is to closely monitor financial stability risks, eliminate current practices of temporary forbearance on NPLs, and improve the insolvency regime and build capital buffers. Going forward, financial sector reforms will be important, including reducing the public sector's role in that sector. Finally, economic resilience will hinge on modernizing macroeconomic institution and addressing long-standing structural priorities. Now looking over further ahead, while Vietnam's twin transition from plan to market and from farm to factories and services is far from complete, but the country's strong growth momentum prior to COVID-19 and economic and social achievements to date also provide an opportunity to make the most of Vietnam's considerable potential. Sustained growth and convergence to higher income status will require ambitious reforms to boost growth, which lags peers, including by reducing economic dualism. And as seen on the right-hand chart, there's still a large and relatively low productivity domestic enterprise sector coexisting with a very or more productive FDI sector, and there are weak linkages between the two. On the left-hand side, what we show is that survey-based indicators and anecdotal evidence suggest that there is room to improve the business environment, improving regulatory quality, strengthening governance, and improving tertiary education are areas for improvement. Vietnam has achieved impressive progress towards the SDGs. However, there are large infrastructure gaps remaining, with total additional spending needs estimated at 7% of GDP by 2030 in selected subsectors such as water, electricity, and roads. Vietnam is becoming an increasingly important player in global value chains, so GVCs. Nonetheless, despite some encouraging increase of participation in high-tech GVCs, such as electronics with a large Samsung presence, Vietnam's value added remains low-skilled. Domestic connections to GVCs are weak. That is, GVC and FDI firms are relatively disconnected from domestic firms, both suppliers and services, and strengthening positive spillovers to the domestic economy will be the key to boosting productivity of domestic enterprises. Finally, Vietnam's a relatively young country today, but it is aging fast, with the old age dependency ratio expected to increase threefold by 2050, outpacing several peers in the regions. This is shown on the left-hand side chart. Beyond the required increase in health infrastructure, investment, deeper reforms in the pension system are a priority. Another key challenge is climate change, where Vietnam is highly exposed. The right-hand side chart measures two aspects of exposures: readiness and vulnerability. Readiness is on the x-axis and vulnerability is on the y-axis, with the red line showing the sample median for both of these indices. The lower left area captures countries which are most vulnerable and least ready able to adapt, and Vietnam is the red dot. So efforts will be needed to address both climate mitigation and adaptation given its long coastline. So that's it for me this morning on Vietnam. Thank you.
So my presentation, would be three parts. So my presentation title is about the impact of the COVID-19 pandemic, but basically there are three parts. So I will outline the macroeconomic situation and also trend of Cambodia prior to the COVID-19 pandemic. That's the first one. The second one would be about mainly for the impact of the COVID-19 pandemic on Cambodia. Then the last section is about the policy response and the policy priority issues. Then move to the first part. Okay. So Cambodia, yeah. So Cambodia's growth performance was impressive. So if you see the chart on the left-hand side, basically, Cambodia recorded the high, growth rate with a range of around 6 to 7.5% in the last 10 years. So of course, 2009, it was that was a year of a global financial crisis, GFC. At that moment, actually Cambodia's growth rate was close to zero. It was 0.1 percentage point. But after the global financial crisis, in the last 10 years, mostly their growth rate was impressive with around 6 to 7%. So then the main driver of the growth that you can see, red part, which is, coming from the garment sector. So garment sector and the construction and the hotel and the transportation are the key drivers for the growth in the past. Then of course, in the before the COVID-19 pandemic, we expected the growth rate is around 7% going forward, especially for the 2020. On the inflation rate, it was also very moderate and stable. You can see the chart on the right hand side. Then basically, Cambodia could maintain the price stability. It's also impressive in achievements. Then basically with a range of around 3%. So if you see the contribution to the change of CPI inflation from the chart on the right hand side, so you can see that the blue colored area, which is coming from the food price inflation. So we can explain that most of the inflation volatilities stemming from the food price inflation. So the inflation volatility can be explained by the food price inflation, mostly in Cambodia. But we can say, price stability were maintained in the last 2 years. That's also the important achievements. So we can say Cambodia recorded robust growth and the low inflation. Then the next chart is about the fiscal, performance. Fiscal revenue, which was also the impressive. Their fiscal revenue has been on rise in the past, decade. So, in 2007, their fiscal revenue in percent of GDP was less than 15%, but it's approaching to around 25% of GDP. Then if you see the chart on the right-hand side, tax collection. So tax collection in percent of GDP of Cambodia, which is almost around 18%, which is of course beyond the average. So tax collection is also the main driver of this impressive fiscal revenues. So Cambodia, yeah, of course Vietnam is better. So the François made some presentation on the Cambodia and the basic tax collection fiscal revenue performance. So while his presentation is saying that the Vietnam is still lagging behind, but actually Vietnam is a leading performer in this region. So Cambodia is following. But anyway, we can say fiscal revenue performance is impressive in Cambodia. So actually in the last 2 years, in 2019 and 2018, Cambodia could pose a fiscal surplus by accumulating that huge government deposit, which can be a source of financing at this moment for COVID-19 crisis. So there's a fiscal surplus. So then the DSA, debt sustainability analysis, we take a look at the public debt sustainability. Cambodia, we can say that risk of the external debt distress was low. So, percent of GDP, if you see the public debt in percent of GDP, which is less than 30%. So then if you take a look at the chart on the right-hand side, basically the all of debt, dynamics, I mean, baseline and the shock scenario, or, were below the, threshold of, our, benchmark. So actually, Cambodia's debt indicators, the all of indicators show below the threshold of the debt sustainability level. So we can say there's a space for Cambodia to borrow more, including China, Korea and Japan and whatever the bilateral and also the multilateral financing partners. So of course that should be concessional for Cambodia. That's going to be also important. So then, but external position, so current account. So the current account deficit was widened. It's around minus 12 and 13% of GDP. So of course, imports is very strong. So because of the such impressive growth, Cambodia's absorption is very high. They needed import. Of course, if you want to construct something in Cambodia, you need to import steel and cement, and that cement can be produced domestically in parts, but many of construction materials needs to be imported. So anyway, if you have a high growth, you have a high absorption, that's going to be a strong import, and that's going to be a part of the widening current account deficit. Then such a current account deficit were mainly financed by the FDI, as shown from the chart on the right-hand side. So FDI is a key driver for Cambodia to finance. Of course, Cambodia received the concessional borrowing, lending, concessional financing from Korea, Japan, and also the bilateral agencies, and also from China. So then the financial sector. So of course, economic growth was impressive, as I explained to you. It was almost around the 7% of GDP, 7% for the growth rate. Then this growth rate was supported by the, as I told you, construction and the real estate sector. So there is a big finance behind. So if you take a look at the chart on the right-hand side, so basically credit growth was very high in Cambodia. Of course, Cambodia is still at the early stage of financial deepening. So that's why credit growth could be higher because of the low base. But having said that, the situation in Cambodia, we can say their credit activity is a bit, basically stronger than the level which can be justified of the fundamentals. So if you see the chart on left-hand side, so credit to GDP gap. So actually the threshold is 10 percentage point, which was set up by the BIS. Basically, this is one of the exercise to see how we can justify their credit activity. Of course, if you are at the early stage of financial deepening, your credit growth tends to be higher. But in the case of Cambodia, it looks like the pace of credit growth, which is way higher, way faster than the level justified fundamentals. So that's why we are saying that we caution the authorities. We have elevated financial sector vulnerabilities in Cambodia. So that is some, key issues before the COVID-19 pandemic. So then let's move to the next section to see the impact of the COVID-19 pandemic on Cambodia. So Cambodia seems to be successful in containing the virus so far. So total number of the confirmed cases in Cambodia is still below 300. I think 273, that is the latest number for the total number of persons, the confirmed cases for the COVID-19. Then there is no fatal case, no deaths so far in Cambodia. So if you see the chart, this chart, you see the light blue bar. So actually Cambodia has a first wave in the late March. Then recently they had some second wave. I don't know whether I can define those two, whether I'm not sure whether I'm correct by saying that those two waves, but looks like we have two waves, but there's small waves in Cambodia in the past. So then interestingly, if we take a look at the containment stringency index, and basically Cambodia, of course, they have a strict travel restrictions against the international travelers, but domestically, basically, my understanding, they of course, club are not allowed to open, but basically domestically, their economic activities are basically, allowed. So that's why the containment stringency index was high previously, but it's around 0.4. I understand that this is a relatively, milder. But of course, if we take a look at the, this number of persons for the COVID-19, almost all of cases are imported. It's not the domestic one. So that's why their quarantine policy for the international travelers are very strict. So that is going to be one of the successful factors for them to contain the cases. So, but of course, their health system is underprepared. So if you take a look at the chart on the left-hand side, it's about the number of physicians. So Cambodia is one of the lowest, lowest number of physicians. The doctors are not ready in Cambodia. If you take a look at the chart on the right-hand side, hospital beds per thousand of the population, Cambodia is also, one of the lowest, level in this region. So that's why Cambodia's health system is basically is not well prepared for the pandemic. So then, of course, Cambodia, from the economic viewpoints, Cambodia has been well connected to the global economy, partially through trade. So if you take a look at the chart on the left-hand side, so it's about the trade openness in percent of GDP. It's a sum of export and import in percent of GDP. Cambodia is, exceeding 120%, which is a comparable to ASEAN average, but which is way higher than the rest of the world. So Cambodia is well, connected through trade, and of course, foreign direct investment. So if you see the chart on the right-hand side, it's basically the level of FDI, which is basically, exceeding the, 12%. It's approaching to the 14%, which is way higher than the, other peers. So then, international tourism receipts. In percent of GDP, Cambodia, it's almost to 20%, which is way higher than the other, countries. So Vietnam is around 4%. I don't know, but anyway, Cambodia is way higher than the other, peers. Vietnam, Laos, Myanmar, Cambodia is highest. So then, if we also take a look at the chart on the right-hand side, it's about the remittance receipt. So Cambodia's level of the remittance is at around 6% of GDP. So that is also the high. So we can say Cambodia is exposed, the system to the global. So then the channels are like trade, investment, tourism, and the remittance. So that's why we can say Cambodia is not immune to the global economic slowdown. The tourism and trade, FDI, and the rural remittance, and domestic consumption. So slowing down, reflecting the weaker consumer confidence. So those are all channels which may adversely impact Cambodia's economy. So then let's take a look at the recent developments. The tourism was collapsed. So yeah, of course it's everywhere. If you take a look at the chart on the right-hand side, so for the first 6 months of this year, total accumulated number of international tourists arrival to Cambodia was just 1.2 million, so which is illustrated by the orange color. So of course, which is lowest level in the last 5 years. So then trade. If you take a look at the chart on the left-hand side, it's about the selective exports growth. So if you take a look at the red line, which is showing the performance of general garment, that export performance is basically weak. Basically already slowed before COVID-19 pandemic, because of the issue of everything but arms. Is a trade preference schemes by the EU. It was suspended. There's a decision by EU for the suspension of everything but arms preferences, which was actually effectuated this month. So that is one of the issues already there before the COVID-19. Basically, trade performance, export performance of garment was already impacted by that EU's decision. So some garment orders by global buyers were already slowed. So then the plus now COVID-19. So that's why garment is somehow affected very seriously. So then some electronic vehicle parts, but the bicycle is somehow exceptional. So it's still on rise. The bicycle export is okay. But the share of bicycle export is not so high. So that's why overall export is not, impressive. Then if you also take a look at the chart on the right-hand side, it's about the selected imports growth. So of course, Cambodia is following that, cut pack make model for the garments industry. So if the orders of garment is slowed, that means the import of garment materials will be also slowed. So that's why if you take a look at the light blue line of garment materials, that is also slowed. Yeah, it's basically linked to the weaker export performance of a garment. So import of garment materials are also slowed. But also you also take a look at the construction materials. It's a red line. That is also important sign. So because of slowed construction activity, so that's why construction materials import are also slowed. That is a bad sign. So basically, some slowdown of domestic activity is also reflecting that such a slow import of construction materials. So probably private investment and the public investment, some of the construction activities are already slowed in Cambodia. So food beverages is also slowed. So basically, by reflecting that the weaker domestic activities, imports are also slow. So then, but the good news is international reserve. Basically, central banks keeps offshore, foreign reserves. It's maintained. It's it's not basically under, under the pressure. The international reserve is still there. So meaning that some current account deficit was still, financed by some investment inflow. So it's very difficult for us to know what's going on actually on the investment actually inflow. But at least for the optional foreign reserves were maintained by the central bank. So then the price remains relatively stable despite pressure on the food prices. So again, the inflation rate, the latest level is also around 3% for the headline, as shown from the chart on the left-hand side. But the food price is somehow on rise. But of course, non-food prices are down. For instance, fuel prices are also down. Reflecting that the weaker world, gasoline prices. So exchange rate is also, basically stable. This chart is tricky, but if you take a look at the, scale of the, axis, basically it's just around 4,000, so basically the chart is showing some, move of the exchange rate, but basically this move is very marginal. So, their local currency, Khmer Riel as against US dollar, the daily exchange rate is basically stable. Cambodia is a highly dollarized economy. Basically, it's a peg. Their exchange rate is basically peg to the US. So then the exchange rate looks stable so far. No huge move. And then of course international reserve. As I show you their chart on the international reserve. International reserve level is stable. The pressure is limited and exchange rate is stable. That is good so far. On the fiscal, of course, tax revenue on the left-hand side. So that's also somehow, still okay. So their tax revenue so far is on in line with the level of the last year. So, of course, the domestic activity was slowed. Then, of course, government announced some measures to relieve, some, industries like a tourism garment by providing some tax relief. So probably tax revenue could be slowed later, but for the first 6 months, which is comparable to the level of the last year. But of course, for the spending side, if you see the chart on the right-hand side, the red line is we're exceeding that last year by reflecting that some more cash out for the support to the poor and and the health sector and some spending pressures and So that's why, as I explained to you previously, there's a fiscal surplus in the last 2 years. But of course, this year, the fiscal gap could be, widened. But they had some, government deposit accumulated previously, reflecting that some fiscal surplus in the last 2 years. So that's also the, important buffer so far. They can use that government deposit. So then the monetary front, then credit growth was very high previously, but we was also slowed. It's around less than 20% now, but still it's around 20%. So deposit growth is also around 10%. So yeah, it's softened, but I think it's good for this moderation. But it's not collapse, so that's also good. There, banks, keeps providing some financing, including microfinance. So yeah, we need to be careful about the level, but monetary front, the financial front, which is softened, but it's still working. That is good. So then, against these backdrops, our outlook, especially for the growth rate. So now we're projecting that the growth rate for this year in Cambodia is about the minus 1.6%. So basically, which is comparable. The authority is also projecting that the growth rate for this year is around minus 1.9. But of course, our growth rate projection for this year is still based on the assumption on the April, World Economic Outlook, global, assumption. Then of course, World Economic Outlook will be updated, soon in October. So maybe, reflecting that, worsening that the external environment. So this growth forecast could be even revised into the downside. But still we are saying that it's a minus 1.6% at this moment. The inflation is moderated, but it's still under 1.5%. That's our projection for this year. But the fiscal gap. So if you take a look at the line of net lending and the borrowing, so it's negative minus 1.9%, which is comparable to the fiscal gap. So we can say fiscal gap was used to be a surplus, like a 0.7% in 2018 and 0.4% 2019, but which is going to be in negative, meaning that the fiscal deficit would be expected for this year, which is going to be at around minus 1.9% of GDP. That is for this year. So current account, that's a bit difficult to project because export is weaker, but the import is weaker. But which side will be much weaker? It depends, right? So, but we are expecting that some widening current account deficit for this year. So import could be slowed, but export could be more, much more. So that's going to be our latest projection at this moment, but which can be revised again by reflecting that the new World Economic Outlook assumption probably this coming October and November. So then the risks tilted towards downside significantly anyway. So we expect a minus 1.6% growth this year, but going to be lower depending on the assumption. So there is the COVID-19 pandemic is going on, and if its impact on the global economy is worse than expected, then of course the growth rate for Cambodia will be for the downside. But of course, even before COVID-19 pandemic, there's some risks already for Cambodia. Again, either everything but withdrawal issue by EU, which is still the issue. So actually EU. Cambodia requested the EU to postpone the EBA withdrawal, but the EU did not accept that the request, and the EBA was just withdraw, suspended this. So then, of course, external risks are already there. So, but basically, it's also now associated with the issue of COVID-19. So external risks can be intensified, of course, with the protracted COVID-19 pandemic. So then let's take a look at the policy response and policy priority issue. So anyway, Cambodia. So focus on health is still the issue. So impressively, the authorities announced the master plan of the health sector, how to respond to COVID-19. They announced that master plan very quickly, April, and then the government started to spend and some health-related, expenditure. So their budget is around 60 million US, which is, still small, but they put the first priority on that health. That is good, which is in line with our expectation. Then, of course, second issue is about the protect the most vulnerable. So basically, they started to make, subsidy cash subsidy for the poor and the vulnerable. It's around the 400 million yesterday. That's also they are using that some existing scheme ID poor, which is good mechanism to target who should be a beneficiary. So of course timely, targeted, and temporary. The 3T is an important principle to deliver the such support. So then basically the Cambodian government is trying to use that the 3T principle to deliver their cash support to the poor and targeted subsidy, timely subsidy, and time bounded. Then on the third issue is mainly from our views, but it's about the financial sector issues. And of course, that is going to be challenging. Credit growth was so high, but the credit activity should not be collapsed. So it's not good for the economy and for everyone. So we need to find out the best balance between the two. So we need to maintain, but we need to soften. So then anyway, Central Bank, National Bank of Cambodia, they already took some measures by giving some regulatory forbearance for the commercial banks, basically by allowing the some time for the borrower. So of course it's difficult to identify which is the solvency issues, which is the liquidity issues. But basically, central banks give some time for the banks to communicate with the key borrowers. So they, of course, that's also the important strategy to buy time to wait and see. But of course, they need to keep doing their prudential measures. I mean, by communicating with banks through the on-site and off-site. And of course, it's better for the banks to have good communication with the public to give some confidence. So those are policy priorities and for the moment. But of course, for the medium-term issue, post-COVID-19, it's very difficult to say when it's going to be started for the time or the post-COVID-19. But of course, fiscal sustainability is a issue for Cambodia. So of course, their revenue side is on rise, but medium-term fiscal framework needs to be established. But it's very difficult for them to maintain the medium-term fiscal framework at this moment with such a big shock from the COVID-19. But right after that, this COVID-19 shock, and then they need to refine their MTFF, medium-term fiscal framework. So that's going to be an issue to sustain some fiscal front. And then of course for the financial resilience, that's also the issue. So they can buy time, but so they need to establish some deposit protection scheme and also the resolution framework to develop the crisis management framework. That's still the important issue for the Cambodia. So Cambodia is a highly dollarized economy. So basically, lend of last resort function cannot be expected for the central bank. Central Bank of Cambodia cannot issue the US dollar. So that's why they need to make some de-dollarized efforts and then to establish some lend of last resort function at some point. So that's going to be an immediate term issue. So that's the end of my presentation, but I'm sorry. So when I take a look at the presentation by François, so actually, I needed to, show some list of the structural reform issue for Cambodia. And it's basically same from from the slides by that, François. So with that slide, I'd like to, emphasize that, global value chain. That's also the issue for Cambodia. But Cambodia is lagging behind Vietnam. So Vietnam is very strong from the Cambodia's viewpoint. The question is how Cambodia can complement, or how Cambodia can find out a space for the part of the global value chain. So then, of course, aging is also the issue. So now Cambodia is very young. Cambodia is one of the youngest economies. So Cambodia can enjoy the, population dividend for the moment, but it's going to be aging. But it's slow. It's going to be, later compared with Vietnam. So then climate change, yeah, of course, Vietnam is exposed that climate change risk, but Cambodia is also the a country for the climate change. So infrastructure gap is the same. So all are suggesting that they need some investment and finance or support from Korea. So anyway, so that's my some additional message. But this is the end of my presentation. Thank you very much.
Again, thank you very much for the invitation. This presentation is on Laos, and it's divided in three parts. First, I'll discuss the pre-COVID-19 vulnerabilities of the Lao economy. Then I'll discuss the impact of COVID-19. And then I'll finish with a presentation or a brief discussion of policy priorities. Lao had long-lasting vulnerabilities prior to COVID-19. As you know, LaoPDR is the only landlocked country in ASEAN, and instead of relying on export-oriented, labor-intensive industry like its peers, Lao achieved a solid growth, averaging over 7% over the past 5 years, by relying on capital-intensive industries, namely mining and hydroelectricity sectors. However, natural disasters, floods, droughts, and infectious diseases weakened the economy in 2019, and then growth is estimated to have slowed to about 5% or below 5% in 2019, given the disruptions in agricultural production and weak hydropower generation. Inflation picked up towards the end of the year due to floods and the swine flu, and the national currency depreciated against both the US dollar and the Thai baht, which increased import prices. As I noted, the exchange rate pressures have emerged in 2019 as FDI and external disbursements slowed down. And you can see that on the left-hand side chart, where the blue line shows the parallel exchange rate in Vientiane, and the green bar shows the spread between the parallel and the official exchange rate. More recently, the spread has been hovering at around 10%. While slow external disbursements kept the gross and official reserves coverage relatively inadequate at about 1.5%, 1.5 months of prospective imports. LaoPDR's fiscal consolidation efforts slowed, and the fiscal deficit is estimated to have widened to about 5% of GDP in 2019, as spending was channeled into natural disaster relief while revenues underperformed because of the slowdown in the economy. On the expenditure side, part of the capital spending was diverted to natural disaster relief, which is appropriate. And the interest bill has grown as public debt stock has continued to increase. On the revenue side, efforts to increase revenue collection via improvement in tax administration and changes in tax policy have not paid off as expected, in part due to recurrent natural disasters and sluggish implementation of reforms. That said, the authorities seems to be committed to revenue mobilization going forward. At the same time, grants from multilateral donors have dwindled to less than 2% of GDP in 2019, and grants are expected to decline further. Spending on healthcare and social protection is among the lowest in the region, as you can see on the left-hand side chart. And then there is no institutional social assistance framework in place. As shown on the the left-hand side chart, there's been large and steady fiscal deficits over the last few years, and they've resulted in an elevated level of debt. Prior to COVID-19, LaoPDR was deemed to be at high risk of debt distress by the World Bank and the IMF. Banking sector fragilities are elevated. Credit growth has slowed down significantly due to the economic slowdown, but it may also reflect banking sector vulnerabilities. Official data indicates that capital buffers are becoming thinner. For instance, the capital adequacy ratio has dropped below 12%, which is considered to be the rule of thumb benchmark for developing countries. And while official data indicates that NPLs have remained broadly constant at about 3%, there are discussions with commercial banks suggest that there are significant variations across banks and maybe that NPLs are underreported. What is the short-run impact of COVID-19? So let's look at that quickly. In the wake of COVID-19, we've revised down our real GDP projection for LaoPDR from 6.5% growth in 2020 to 0.7%. And this 5.8% downward revision to growth reflects mostly the impact of COVID-19 on domestic services and tourism. As I said earlier, a lot of the growth comes from electricity and mining, or has in the past, and they're less affected by COVID. So LaoPDR has contained the spread of COVID-19 well, with only about 20 cases confirmed so far. But it won't be immune to the impact, to the economic impact. And this is what we're seeing now. And given the limited fiscal space, the policy response to the shock, at least on the fiscal side, has been muted. The central bank has cut its policy rate, the reserve requirements, in order to boost credit growth, and has also asked banks to help borrowers affected by COVID-19. COVID-19 has impacted all the sectors in the economy except perhaps electricity and then agriculture also. Tourism arrivals have basically stopped, and estimates indicates that tourism contributes directly about 4.5% of GDP. But as I said, the impact of COVID will be felt through most of the sectors of the economy, as you can see on the right-hand side chart. This is a quick view of the macro impact. And it shows basically the post-COVID projection versus the pre-COVID projection in terms of real GDP, the fiscal balance, and public debt. And so what you can see is that real GDP growth is expected to be lower in both 2020 and 2021, indicating a large output loss. The fiscal deficit is expected to widen to about 6% in 2020 and 5% in 2021, mostly because of lower revenues due to low growth. And then the lower growth and larger deficits are expected to lift the public debt to GDP to around 70% in 2020 and 2021. And of course, the large current account deficits coupled with slower external disbursements and FDI are expected to limit the ability of LaoPDR to rebuild its FX reserves. The other thing, I guess, to note is that domestic risks dominate. There's significant uncertainty associated with the duration and the extent of the pandemic. Any additional episodes of natural disasters or slower than anticipated recovery among trading partners could further compound macroeconomic vulnerabilities. LaoPDR PPPs, or private-public partnerships, related capital stock is the largest in the region at almost 76% of GDP. Again, in the event of a severe drop in investment or financing flows, PPP-related contingent liabilities may materialize and affect the fiscal situation more. Finally, large financing needs and limited access to international capital markets could lead to liquidity pressures. So what are the policy priorities for Laos? Here, what we're presenting is fiscal and macro financial policy priorities, and we divide between immediate actions or short-term actions and medium and long-term actions. On the fiscal side, the short-term priorities are to maintain the livelihoods and providing adequate health services, especially to the most vulnerable. But given the lack of fiscal space, expenditure reprioritization may be necessary to achieve this goal. And in some ways, the government is doing that because they're cutting administrative expenses significantly to try to contain and reallocate these resources. Working with creditors and multilateral financial institutions to secure additional financing or reprofiling existing debt to cope with spending pressures related to the pandemic and revenue shortfall. And under this, Laos is eligible for the G20 Debt Suspension Service Initiative, but they have yet to request it. Improving the third priority here would be improving transparency and data collection would help secure additional financing needed for immediate needs. And then finally, divestment of state assets to raise additional financing could be considered. Over the medium term, the fiscal priorities are, well, after the pandemic, the priority is to return to fiscal consolidation by raising revenues as opposed to expenditure compression. The second priority would be to improve debt management and public investment management, and then strengthen public financial management. And here the government has agreed to comprehensive multi-year public financial management reforms strategy supported by several development partners. And this would include the development of commitment controls and quarterly spending ceilings to reduce the risk of spending arrears. In terms of macro financial policies, the short-term priorities are to preserve the stability of the deposit and payment system, monitor closely credit liquidity conditions and foreign exchange markets and inflation. Of course, some banks could face liquidity pressure due to COVID-19, particularly if those banks had weaknesses prior to the shock. So the Bank of Laos may consider providing emergency liquidity assistance to solvent and viable banks against adequate collateral. And over the medium term, the macro financial policy recommendations are to rebuild reserves and modernize the monetary policy framework or monetary governance, develop a debt securities market, develop and strengthen the bank's crisis management and resolution framework, and improving bank supervision and accounting standards. So that is, in a sense, our policy recommendations and a short overview of the economic and financial developments in Laos. Thank you.
Okay, thank you very much. I would very much like to be there in person, but unfortunately we can't do that, so we're doing it this way. But I look forward to meeting you all at some stage. So today I'm going to talk about Myanmar. It's a relatively new country to the international community and to the international market. So I'll give some background on Myanmar, and then I will talk about the current situation, including the response to the pandemic. So let's talk about the context of Myanmar. It can be described in a number of ways. First of all, we can see it as a frontier market. It's only relatively recently joined the international economic system, as we know it, after a period of isolation in the post-colonial era. So it's very much of what investment bankers like to call a frontier market. It's a low middle income country with an average per capita income of about $1,000 per head. It's a relatively large population of around 55 million, mainly rural based, and most people work in the informal sectors. So the formal sector is relatively small. And as a frontier market, has enormous infrastructure gaps and needs to improve human capital. And we can say there are missing and incomplete markets, especially in the financial sector, where the banking system is very rudimentary, and it still has a lot of controls. So although the markets are developing, it's still at a very early stage. We could also characterize Myanmar as a fragile state. It has a history of conflict, especially in the border areas. And only recently, in 2012, from 2012 era, had a period of liberalization. They had the first elections several years ago, and there's now the second democratic election taking place this November. So I think we can really see Myanmar as having a number of transitions underway at the economic level, at the political level, at the social level. And to make sure these transitions work well, there are a great deal of policy reforms and initiatives needed for Myanmar to gain its potential. And in that sense, let me just highlight some of the reforms that are underway. So it's moved a long way from the previously centrally planned type economy to a much more market-based economy. The Myanmar Sustainable Development Plan has been developed by the authorities. It's their plan, but it came with a lot of assistance from the development partners, including the IMF, the World Bank, ADB, and the UN. And that's really the template for reforms going ahead, and focuses on capacity development and the huge physical infrastructure needs. So just to give you a sense of the type of reforms that are underway, we've seen a big opening up of the economy. Myanmar joined ASEAN in the late 90s, and since then has been participating in the economic integration in the ASEAN region. And to cite a few examples, a lot of workers from Myanmar are in neighboring countries such as Thailand and Malaysia, and they send remittances back, and that's very positive for the rural economy. A lot of banks, especially from ASEAN, are interested in the domestic market and have set up branches, and now reforms have now allowed foreign banks to become subsidiaries. So that's something that's ongoing and will improve the financial system in coming years. The foreign exchange market has dramatically opened up. In the past, there were a whole number of controls on exchange rates and transactions. By and large, those have all gone. Now they have a competitive foreign exchange market, and the exchange rate is determined daily according to the market. And the good news is that Myanmar recently accepted the Article 8 of the IMF. Sounds a bit technical, but in fact that is a sign of global integration. Only 10 countries or so in the world haven't agreed to the articles, which basically promote ending exchange restrictions and controls. So that's very good news, and I think it's a very good symbol of Myanmar's progress. Additionally, a lot of work's been done by the Ministry of Planning, Finance and Industry in terms of better public financial management. I think that's something that's also going to be intensified in coming years. So if we look at the pre-pandemic economic situation, we can see that Myanmar's been reforming to develop its potential. And I'll just briefly say something about the potential of Myanmar economy. Its geographic location is very well suited to regional integration. It borders China, Yunnan province, also borders India. So a lot of economic activity can take place with these two fast-growing neighbors. Also with Thailand, there's a lot of cross-border flows. So it can gain from regional integration. It has a strong competitive advantage in export-orientated agriculture, and in fact used to be one of the biggest rice exporters in the world. So there's a big potential there, not only of rice, but other products such as mangoes and durians, etc., especially for the Chinese market. It has a lot of other natural resources, including jade and precious stones, gems. And also for large population, it has an advantage in labor-intensive industry. And in fact, the garments industry was doing very well before the crisis. Particularly for export to Europe. So multinationals were coming to Myanmar to produce for export, very much the ASEAN type model we saw in the past, and that was working quite successfully. So a lot of gains to be made. The economy was doing quite well, growing around 6% or so. Could have grown stronger, but I think 6% was quite good, especially on a regional basis. Economic policy making was very prudent. We had good fiscal policies, and we assessed the situation as having a low risk of debt distress. So very, very prudent debt policies. As I mentioned, the garments exports were doing well, and the rural economy was quite resilient, especially boosted by remittances from workers overseas. But there were some areas that needed strengthening. One was on the investment, and we did see FDI flows easing off after a big boom several years ago. Myanmar needed to do more work on the sort of doing business type areas, improving efficiency, cutting red tape, those type of things. Financial sector, there's still some legacy issues from the past which need to be addressed, and there's also an issue on the anti-money laundering side, where the international community through FATF has set out a number of areas for improvement. So that was the situation up to recently, and now with the COVID pandemic, the situation has turned quite dramatically. I'm fairly confident that once this pandemic eases, Myanmar will return to its former track, and these positives and potential that I mentioned earlier will come back to the fore. But for now, obviously, it's a very challenging situation. The good news is that there's been a very limited domestic spread, similar to some of the other countries in ASEAN. It's had a very limited domestic impact. There have been around 360 cases so far and only 6 deaths by mid-August, which is very good by international standards. But of course, the economy has been hit by a number of demand and supply shocks, and these are mainly related to the global impact and, of course, the domestic impact because of the various lockdowns. So we can see from this slide, there's a very limited number of cases. And in fact, most of the cases that are being detected, 1 or 2 every day, are really from migrant workers who are returning. So that shows that the detection at the airport and other ports of entry is working. So far, we haven't seen any sign of domestic contagion, and let's hope that continues. But of course, it has to be said that the testing capacity has been limited, although the international community is supplying a lot of the equipment, and the testing is increasing. So again, that's something that's ongoing at the moment. The testing facilities are being ramped up. But let's look at the impact. So really, there's so many uncertainties. So what we do when we model the impact is to look at the baseline situation, and then as I think it's more prudent to look at some adverse scenarios of what could go wrong if the situation deteriorates, if there is a domestic contagion, or if the global situation carries on for longer into 2021. So it's clear that GDP growth will fall as most of the key drivers slow or negative. But as our latest numbers are sort of around between 1-2% GDP growth for this year. That is actually quite strong growth compared to others in the region. And I think it's indicative of some of the strong fundamentals in the economy. The fiscal deficit will also rise, largely because revenues will fall, especially from oil and gas exports. And of course, expenditures will need to go up, especially on health and social safety nets. So here we can see some of the economic growth drivers all going down. So output is down, employment has fallen, and we're seeing very weak sort of demand for products. And in terms of the growth implications, we've done some disaggregated modeling on a quarter-by-quarter basis, and it's clear that the lockdown that took place from March onwards had an impact on domestic activities, even though it was very necessary to do. Obviously, various measures such as limiting transportation between cities, limiting people's access outside their houses, shutting down businesses like restaurants and hotels, obviously has an impact. In the best case, we would look at quite a sharp growth recovery once the crisis ends, but that's mainly because of base effects. So it's more of a statistical recovery. Of course, in level terms, there'll be a much more lingering consequence of the crisis. So here you can see that we've looked at real GDP in constant shut, and it will take some time to recover back to pre-crisis GDP. Just looking at the revenue side, and oil and gas is almost 2/3 of government's revenues. And although demand has held up because most of the gas goes to China and Thailand, and of course international prices have fallen quite substantially, so that's likely to hit government revenues quite substantially. And one consequence of crisis is that the poverty gains in recent years will be hit. Although poverty reduced quite sharply in recent years as a consequence of the reforms, it's still clear that there is a sizable poverty pool in Myanmar, and also a lot of vulnerable people close to poverty. The informal sector is a sort of proxy for this. And with the lockdowns in place, a lot of the workers in the informal sector have suffered. Also, remittances from countries such as Thailand have fallen very sharply. So that supported rural incomes. That's now come to an end. And sectors like tourism have also ground to a halt. And that was quite an important source of income, especially in rural areas. So the chances are that poverty has increased. So in response, the government has set out the COVID-19 economic relief plan in April 2020. And it's a very comprehensive plan, and appropriately focuses on stimulating the economy, undertaking proactive monetary and financial sector policies. And for instance, the interest rates have been cut quite substantially, and channeling expenditures to health and strengthening social safety nets. So we support these policies, and you can see here some of the particular expenditure-orientated policies they're undertaking on health, social assistance, and support for businesses, including SMEs, small farmers, etc. So, of course, there are going to be a lot of spending needs. And here we can see that in the past, the government has underspent on health and education. These need to be boosted as a response to the crisis, particularly on the health side. And of course, there is a risk that if this pandemic does come more serious here, that Myanmar, because it has limited health capacity, will suffer even more. So I think all this means that the government will have to spend more. And as part of this, the international community has offered various mechanisms for assistance. And I would cite that the IMF has now given an emergency loan for budget support to Myanmar. It's under the IMF's Rapid Credit Facility and Rapid Financing Instrument, very concessional terms. Just over $254 million was dispersed in June, and additional support is available. And you can actually read all the documentation on the IMF website, including the commitments by the government to undertake and continue the reforms I mentioned earlier. The IMF assistance helps catalyze additional funds from other development partners, and that will help fund the economic response plan, and particularly to help finance needed expenditures, particularly on health and social safety net, particularly for those workers in the informal sector. I would also highlight that Myanmar has availed itself of the G20 debt servicing suspension initiative, which basically freezes the debt servicing for this year, and that helps relieve liquidity pressures on the budget. In tandem to these financing policies by the international community, there's also a lot of capacity development, and this is very important to improve capacity of the government, improve implementation and governance. And I'd highlight in this context that Myanmar is one of the biggest recipients of IMF technical assistance and capacity development in the world in a number of areas, including fiscal, monetary, and governance areas. So I would conclude by saying that clearly the crisis is going to linger. I think this means that the legacy of the crisis will remain for some time. The reforms that the government was undertaking before the crisis will need to continue, particularly on improving the policy frameworks, improving capacity, and the skills, especially in the government sector, and improving also the skill base in the general population, particularly to continue to make Myanmar attractive to foreign investors. So all of these need to continue. The legacy of the crisis will be obviously more debt, and that will need to be very carefully managed in the future. The good news is that the starting point is quite prudent. So Myanmar has been good in terms of keeping a prudent debt record. But that will be one of the challenges in terms of the policy mix in future years, is maintaining prudent debt while having appropriate fiscal and monetary policies, as well as capacity development. So I'll leave it there and look forward to the questions. Thank you.